right. Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. Today on Thursday, February 11th, certainly a lot of exciting things happening in the market. There's been a lot of new attention on silver. And without taking people too far down the rabbit hole today, for all the things that you love about silver, it turns out most of them are also in place for some other assets, which fortunately, my dear friend Scott Melbye, Scott, I guess it's, I would say at least 3 years since we first met, and been really a pleasure getting to know you. You were mentioning before, we haven't gotten to see each other at the conferences lately, although
yeah.
we'll fix that soon enough too, but a pleasure to have you here today. And how are you doing?
Absolutely great. Thanks, Chris. It's great to be on with your listeners. And yeah, I'm sure we're all eager to get back to live versus virtual connections, but it's great to be with everybody this afternoon.
Yeah, and Scott is from Uranium Energy Corporation and is going to give us an overview of some of these dynamics. And right before we start, I was thinking how cool this is that just through a laptop, essentially we have a TV studio that we can share these messages, because perhaps along the lines, maybe I shouldn't start counting silver profits just yet, but I like thinking of, okay, let's say silver goes to $50 and you have a big profit. Again, by all means, nothing in this call is legal financial advice, but what do you do? I'm not going to be in a rush to go back into dollars while Janet Yellen is supersizing the hyperinflation policy. So it's intriguing that you have uranium here. And Scott, maybe you could give us an overview of why there's some intriguing dynamics people might like to know about.
Yeah, well, Chris, absolutely. And again, I have the benefit of being in this uranium industry now for 36 years. Excuse me. And, I've seen the various cycles. Uranium is an interesting commodity. It's not as efficient and mature market as, say, silver or gold or copper, but that's what makes it very interesting. I think when you have an oversupplied market, it tends to be overstated, and you have a really long, low, extreme bear market cycles. But when the fundamentals switch to undersupply, which we're currently underway in that phase right now, those work in your favor, and we tend to have, quite robust and volatile pricing increases like we saw back in 2007 from, 2005, we were trading at $10 a pound to, hitting $137 a pound by 2007. And, we're seeing a lot of those similar factors today. And so, really what's exciting in terms of the narrative of uranium right now, you have a commodity that just on the nuts and bolts of fundamentals, supply and demand, hasn't looked this good in many, many years. Obviously, Fukushima was a big hit to the industry. It added supplies to the market, and it took away some demand in terms of plants that shut down in Japan or phased out in Germany. But as we sit today, almost 10 years later, we've actually replaced all the lost demand or nuclear generation that was impacted by Fukushima, and we're now back at pre-Fukushima levels of nuclear generation globally, and that translates directly to uranium demand. So, for example, in the last 8 years, we've added 53 new reactors to the grid globally, and we have 52 more under construction. So the demand side is extremely robust. But meanwhile, under this long downturn in the price cycle where prices were, at or below $20 a pound, we hit a low of $17 a pound in November of 2016. We finally saw the supply side cut start to kick in, like you would have in any commodity, that supply destruction that is needed. Why did it take so long? We have a lot of hedged contracts in uranium, so producers were enjoying higher prices, $40, $50 a pound. They weren't suffering under $15, $16, $17 prices. So what happened when those hedges fell off? Production started to cut back dramatically. So we've cut 40, 50, 60 million pounds of production over this period. We have a gap now where we've seen consumption globally around 175 million pounds globally. Production this year will come in around a little over 130 million. So that's quite a drawdown in any commodity on the secondary supplies and inventories. So all of this is happening at the same time where we've had kind of utilities sitting on the sidelines. They've been very complacent and quite pleased to enjoy low uranium prices. It's lowered their fuel costs. Uranium is the fuel for nuclear power and electricity, so their fuel costs are important to them. They were enjoying really low prices. So they haven't come back to the market and contracted in normal volumes for probably the last 7 years. That's all changing now as we come out of COVID, as we come out of a lot of trade issues in the United States that had utility sideline. So all those conditions are ripe now for uranium to really see a rally, not unlike what we saw in 2005 to 2007. Who knows if it goes that high or not? But the same kind of fundamentals are in place, with one big exception, and that's green energy, this whole mega trend towards carbon-free energy. Well, nuclear's always been carbon-free. It's always been green. It's always been baseload. It's on 24/7, has 95% capacity factors. That's all been appreciated by us in the industry, but not so widely appreciated by politicians, environmentalists, the investing public until now. And you're seeing, the Biden administration in the US is a great example. If they're going to go down the green energy pathway, and you see, they made some really extreme moves, rejoining the Paris Climate Accord, killing the Keystone Pipeline. They appear to be serious about really putting the boots to fossil fuels. So if you're going to go down that path, the only way you can meet these targets is with nuclear energy. Nuclear energy in the United States is 55% of our carbon-free energy. It provides more carbon-free energy than wind and solar combined. So we have this convergence of supply and demand fundamentals, and now this mega trend of clean green energy really fit right in nuclear energy's wheelhouse. And you have an industry now that is really growing, but the uranium fuel cycle has really been hit by low prices. So we're going to have to play catch up, but it's a classic supply squeeze, not a squeeze that occurred over just days or weeks. It's a squeeze that's developed over years. The past 7 or 8 years, we've seen these conditions develop.
Scott, that was a pretty impressive show, even before you played the encore about the Biden administration. Although I kind of got stunned about somewhere around 2 or 3 minutes ago. Just to make sure that I heard it right and that everyone can be clear, can you give us everything you said there was significant in my opinion, but what was the supply and the demand number that strip all that down? Could I make sure I heard that one correctly?
Yeah. So all the world's reactors today use about 175 million pounds of uranium annually. And globally, we'll be lucky to produce 135 million this year globally. So the rest is coming from excess supplies, inventories. Now the inventories were impacted by Fukushima, but at this rate of drawdown, we're getting to a point where new mine production is needed. So that's if any commodity had that sort of mismatch between consumption and production, it would be getting attention. And then hence it really is now. And, the inventories have been meeting the gap, but inventories are finite. And I think we get to a point where the shelves are empty. We need new production. Well, guess what? It's not easy to license and bring on a new uranium mine. It might take 6, 7, 8 years from start to finish. So mines that are sort of on standby or can restart or are already permitted and licensed really have an advantage here. But still, I think we're going to have a real crunch as utilities come back to the market. And then layer on that small modular reactors and advanced reactors that the Biden administration is really keen on developing. I think they'd like to take some of the lost jobs in oil and gas and put them into clean energy. Well, there's a lot of great jobs in uranium mining and advanced reactors and small modular reactors. So, I think we fit well in that narrative. I mean, I think under a Republican administration, clearly you're part of all of the above energy policy, which is good. You have coal, oil, gas, wind, solar, nuclear. But here we're in a tight group where if you really make it hard on fossil fuels, you really need to rely on nuclear, both the existing fleet, that's 20% of our electricity today, and these new advanced reactors that are really gaining traction today.
Yeah, and Scott, just in case, I'm not sure if it froze for people at home, but just to be clear, make sure we had that right. You said that 175 million pounds is the demand, and we're going to get about 135 million as the supply.
Yeah. Yeah,
Okay.
it's really been impacted too by COVID over the last year as well. We've seen additional cuts to that as well. So COVID played a part where it impacted the supply side, but didn't impact the demand side. The nuclear plants ran 24/7 through the whole COVID crisis without impact, whereas the mines saw cutbacks in operations all around the world.
All right. And I'm going to pull our chart back up here, but maybe a two-parter, if I may. You said that it's coming from the inventory. So what is the known inventory? And maybe we'll just start with that one.
Yeah. So there's a number of, it's easy for us to pin down what is demand each year. The number of reactors is known. We know how much they're consuming. We know how much mines are producing and contributing to the market. The inventories are the most opaque in that sense. But, folks like Uranium Exchange Corporation, have pinned down, what these truly excess supplies are. We're not counting inventories that say the Chinese government has built up to support their rapid growth in nuclear energy. They have 50 reactors. They're going to surpass the US in nuclear capacity in years. We don't count that inventory because it's not liquid to the market. If you just took material that was liquid to the market going into this last 2 or 3 years, we maybe had 275 million or 300 million pounds globally that we would consider excess. That sounds like a lot, but when you unpack that, one, we've been drawing down at 50, 60 million pounds a year for the last 3 years. And two, perhaps only 5 to 10% of that's only available to the market at any given time. And that's evidenced in real life when buyers go to the market. This isn't a deep market like copper, gold. If you went to buy 1 million pounds in the market on certain days or weeks, that would clear every pound of supply off the spot market. Other times it's deeper. But we're beginning to see evidence in the amount of material available to the market to indicate that these inventories, have been worked down from the 200-300 million pound levels to something much, much less today. And again, that need for new production is becoming more evident, and that will translate into price improvements as well, because inventories tend to be priced at market, whereas production needs prices to support the capital investment and development. So we're kind of in that transition right now. The next shoe to drop is really utility procurement and get them back in the market buying at normal levels. They've been below normal levels for a number of years, but I think when they start to see the Chinese move or Russia move or state-owned, Korea and France, these big nuclear power programs around the world start gobbling up the available supplies, making investments in mines in countries like Namibia, Australia, Canada, elsewhere, you'll start to see utilities take the market a little more strategically, and that's when I think we start to get a rush on the market like we saw back in 2005 to 2007.
Yeah, and so you said that at least what's known, I want to make sure I have the numbers right, was 300, but was that minus 50 or 60 for the last couple
Yeah,
years?
you would take 100 to 150 away from that figure over the last 2 to 3 years. So, we could be at 150 million excess or 100 million. That's not a lot in a world that uses 175 million annually. And again, not all of that's liquid. And as prices increase, suddenly excess supplies become strategic supplies and pull off the market. And then you get that gate swinging in the other direction. And as uranium prices start to take off and run.
So tell me if this sounds correct. Unless there's some secret mystery pile out there, which I suppose with governments these days, you never can rule that out. But aside from that, we have about 150 million pounds left, and we're running a 40 to 45 pound deficit per year.
Yeah, but again, I think the actual amount that's available to the market is much less than that. And again, you see that empirically in the market when you go to buy materials. So yeah, I mean, we're in a period now where, is it reasonable to say we need new mine production by 2025? And that's on top of Cameco, the big Canadian producer, or the Kazakhs restarting their mines and getting them back up to their sort of stated capacity. We still need new mines to come on in the United States, in Canada, in Australia, and Africa. And that's where the crunch, I think, really hits. And again, the demand side, I don't think has really factored in also these small modular reactors yet. We're still focused on the big, 1,600 megawatt reactors that are built and being put on the grid around the world. Wait till you layer on, 1,500 megawatt reactors in mining applications, in remote locations, in grids that are heavily burdened by intermittent renewables, and you start to really see, the demand side take off again. So we have all the right recipe for a supply squeeze. We're still in the early stages. Prices are still at $30 a pound in the spot market. That's probably $15 a pound below what is the incentive price for the most competitive restarts in the world today, and well below what you would need to bring on a mine that would need, hundreds of millions of dollars of capital investment and long licensing and permitting times.
And Scott, you didn't mention that on top of that, and by all means, not any way even remotely approaching legal financial advice, but I see you have equity options listed on Uranium Energy Corporation. So I'm going to try and hold it together for the rest of our call here today. I don't know if you can top that, but I have a couple more questions and we can dig in.
Yep.
So, wow, this is interesting news. Thank you for being here today. Scott, I went to public school and then Wharton. So I'm a little slow on the supply and demand here. None of those institutions covered that in a non-Keynesian fashion. But when you have, and I would say it sure sounds, I don't, audience at home, I can't guarantee everything Scott said. Sure sounds like you know what you're talking about. So if in your opinion, we have 150 million pounds or less, we're running a 45 million pound deficit, is that the kind of setup that could conceivably put the conditions in place? You're not giving licensed financial advice, but in your opinion, you could even compare what specifically happened here and how that looks versus where we're at today.
Yeah, the spike that you're seeing there is the 2007 spike in the price that went to $137 a pound, up from, really a long, prolonged period, not dissimilar to the bear market that we're just emerging out of right now, where there's been underinvestment in mines. The boost in demand that happened in 2005 was the emergence of new build again in the nuclear renaissance, where countries were again building reactors like they were in the 70s and 80s. So we had that kind of reactor orders coming on. I think what's different this time is back then it was a future growth story. Now we're actually seeing those reactors that were ordered and were constructed are now coming online. So the demand is much more hard demand, and we still have new reactor growth on top of that. So demand is better than it was back then. Utilities have a little more inventory, I think.
God, this isn't fair. Come on, man. But please continue.
Yeah. So the utilities have probably a little more inventory to deal with a shock, but even then, they've been quite content to draw that down. I think in the United States, average utility holds a year to year and a half in inventory. So, they can hold their breath for a bit, and they have been in this recent low-priced market that we've been enduring. But as prices start to turn, you'll see a lot of pressure put on the available supplies. A lot of the mines that were in operation back in the early 2000s, mines like Ranger in Australia have depleted their resources. Mines in Niger and Central Africa are gone. Mines in Kazakhstan that have been producing for decades are depleting, and you have not seen the new investment in the mines that are needed to make up that gap. So we have the perfect storm setting up again. Again, I think if it's a recipe, there's 3 ingredients. The demand side is as good or better than it's ever been. Supply side, the cuts are dramatic, since 2017 to supplies to the market. The third ingredient is really that utility procurement cycle. and that's the next shoe to drop. So if that happens in earnest in 2021, I think that's where you start to see supply squeeze really develop, both in the spot, medium, and long-term markets.
Well, there you go. I mean, I thought last week when the skew on the First Majestic call options came in while there was panic buying in the physical market, I thought, that'd be hard to top in my financial career. And Scott, you're making a compelling case here today. So I guess the only way that conceivably, based on everything you've said so far, it could get more extreme is if it turned out that we were talking about an industry that has heavy government regulation. Please tell me that's not the case.
Well, we have very heavy government regulation to bring mines into production. So it does indeed make ease of entry, I think, understandable to all your listeners. Ease of entry into the uranium mining business is not an easy one. So it takes a long time to get those mines brought on. On the supply side, too, I think, another element that you have to realize is we are heavily reliant on a lot of state-owned entities, particularly in the former Soviet Union. Russia, Kazakhstan have emerged as Kazakhstan is now the leading producer in the world. As long as everything's fine and on the global geopolitics scene, that's great. But things could change there overnight, and so the amount of material coming into Western Europe or the United States gets impacted dramatically, which is why, in North America, we're at a position now where Cameco's mines in Canada have been down due to COVID and just voluntarily cut back to really help really improve the market dynamics and draw down inventories, and they'll bring those mines back on as COVID wanes and contracts are signed. But mines in the US are down to practically nothing now. So in North America, we're one of the largest markets to consume uranium, and we're producing practically no uranium. So that's another element in this story where the big producing countries aren't the big consuming countries, and there are some elements of geopolitics in there as well that we have to take into account.
Yes, Scott, I want to make sure I heard that correctly. You said as long as, the geopolitics are good. So, I mean, U.S.-Russia relations, I mean, how could you get better than that? So you can involve politics even aside from this one if you want, but just all this we heard the last couple of years, Clinton did this, Trump did that, Russia, uranium, you can go to any level of detail you want, but or just at the minimum, if you can, like, what did you see as someone who's just running a business? What could you tell people about that?
Yeah, well, I had the benefit of working at Uranium One during the time when the Russians did take that company private, and so it really, I mean, we could have a whole nother call on the Clintons and the Clinton Foundation, all that. But from a supply and demand discussion, I'll keep it civil here. It really shows that the Russians, the Chinese, these countries play the long game. China is going to be bigger than the United States in nuclear power within the next 5 to 7 years, 10 years max. And they go out and secure their supplies. They buy materials off the market. A lot of this inventory drawdown has really been accelerated by Chinese purchasing into the port of Shanghai and in from Kazakhstan. The entire country of Namibia is practically owned by China today. Why? Because of the uranium there. They own direct interests in 2 very large mines in Namibia and continue to have a big presence there. Why is that relevant? Is, when push comes to shove, the Chinese need that uranium for their nuclear power program. It's not available to Electricité de France or Exelon in Chicago. So it's a real element of our industry. Buyers need to pay attention to, and for investors, it presents, just adds to the narrative. Russia the same. Russia is building 30 reactors in 12 different countries, various stages of order through construction. They're committing to supply 100% of the uranium needs of those reactors, whether it be in Turkey or Iran or Jordan or Egypt. So, we have a big if there was ever a short squeeze, of a grand scale, I think you need to keep your eyes on Russia. I think China's taking the right steps to meet their needs, but Russia probably produces today around 20 million pounds or a little more than that from Kazakhstan and Siberia. They probably need close to 50 million pounds a year within the next 10 years. So they've got to get busy either developing new mines or acquiring existing mines to meet their growth going forward.
Yeah. Well, we will see how that goes. Seems like nothing to, no cause for concern there. Scott, could you touch on any updates, Section 232, and again, just to explain to folks what that is, what it means, and the significance?
Yeah, so during the Trump administration, two U.S. producers filed an anti-dump or a 232 kind of anti-dumping national security case to try to limit the amount of foreign imports coming into the U.S. Under the premise that it was impacting national security. We thought that Trump probably would be sympathetic with something like that, but he went another direction and kind of tried to holistically improve the fuel cycle in the United States, uranium conversion enrichment. So instead of those tariffs or quotas, which would have been very disruptive in the market, instead put in place things like really targeted caps on how much Russian uranium can come into the United States over the next 20 years, or putting in place the National Uranium Strategic Reserve, which is a $150 billion program over 10 years to buy uranium and warehouse domestic uranium for national security and supply security reasons. That has been passed through the 2021 budget cycle. Department of Energy is putting that in place. So it shows that the administration and now the new Biden administration following through on what was a very bipartisan program in the first place, because the budgeting came through in a bipartisan manner. The U.S. is taking steps to try to regain its leadership. We led the world in production in 1980, and we lost it to Canada, who then lost it to Kazakhstan. So whether we get back to that level again would be a stretch, but I think we can be a meaningful supplier to the global market again, and certainly to U.S. utilities where security of supply, whether it's shipping routes in the South China Sea or it's stuff happening in the Baltic or the Mediterranean vis-a-vis Russia, the world is, a complex place geopolitically. And so more supplies that are coming from reliable jurisdictions. In Uranium Energy Corp's situation, we're a Texas and Wyoming producer, and couldn't be a better jurisdiction to both mine uranium, develop its very pro-resource friendly states. So, that's a real selling point. We have low cost, very scalable production, and we are permitted and licensed in multiple facilities to react quite quickly to this price improvement that's coming. It's important. When I put on my hat as CEO of Uranium Royalty Corp, which is an IPO that was successfully launched. Really, UEC was one of the foundational companies that helped launch this company, but we're now a royalty company like Franco-Nevada, Sandstorm, Wheaton Precious, Royal Gold, that invests in royalties and streams. And then we allow our investors to have a diversified pure play in the commodity. And just today we made an investment in royalties in the Cigar Lake and McArthur River mine in Saskatchewan. So, we're looking at who are the companies and developers around the world that have the wherewithal, the resources, the geology, the team, the balance sheets to be able to meet demand in this immediate cycle that we're in right now. So, that's interesting. I get to put my international hat on and invest internationally in Australia, Africa, Canada, the United States. But if, one of the prime candidates to be an early mover in the uranium industry with this recovery is UEC. The Hobson facility in South Texas is a fully functional 2 million pound a year uranium plant that will take resins from satellite operations. We have 3 permitted licensed operations within 50 to 100 miles of this plant that can be operated as satellites to this, and this plant can produce 2 million pounds of yellowcake per year. We're actually looking to extend the license or expand the license to 4 million pounds a year, trying to get ahead and anticipate this change in the market conditions. On the ground at the well fields, we've commenced production of the first well field at our Burke Hollow deposit. It has 7-8 million pounds of identified resources. We've only begun to drill out the extent of that ore body, but that will be in very short time, in terms of months, not years or decades, be able to be developed and start delivering resins to hops and produce, and whether it's selling into the Strategic National Reserve or it is selling to global utilities. We're well positioned there. And we also have our Palangana mine, which is on standby, and also one of the largest undeveloped ISR well fields in the US, in Wyoming at Reno Creek. So we could be firing on multiple cylinders here in response to the uptick in the uranium price.
Yeah, and Scott, we see here, let's call it $29 a pound. Perhaps maybe you can answer this for the industry and yourself. What's the all-in sustaining cost for an existing project? And let's say that, people want to start from scratch and go find some new projects or buy a project. What would the cost of that be in terms of price per pound?
Sure. Well, that it drives home, really the mismatch we have right now is that probably the world's most competitive mines that can start up from scratch, with licensed facilities, license being the key because you don't have the long lead time. Example would be UEC at Burke Hollow. It can restart and start up in a $45 market. Cameco's McArthur River operation, the world's richest, highest grade mine, they have kind of said they need long-term contracts, probably in the $40 to $50 range. Those are the world's best mines and most flexible mines to restart. If you had to invest a fresh $500 million, $700 million, $800 million to build a large conventional mine that took years to permit and license, you're probably going to need $60 a pound or more to make that investment decision. So the longer we linger at this $29 to $30 level, the more that spring coils tighter and tighter, and the more volatile recovery we have, like we saw in 2007. Same thing happened there, where the investment just wasn't coming because of the low prices. Utilities were complacent because of the low prices. And then when demand really materialized and started to grow, that gate swung in the wind very dramatically, and we quickly went to an undersupplied market where there was a rush to cover requirements. And again, back in 2007, we didn't have the Chinese as active as they are now. We did have the Japanese more active. The Chinese were just coming to the market at that time. The Japanese contracted heavily to head off sort of this supply crunch. This go around, I think it'll be the Chinese and the Russians that provide the real impetus, in addition to utilities in Western Europe or North America.
And Scott, what else hadn't happened back in June 2007 when uranium hit $136 a pound? We didn't have quantitative easing 1, 2, 3, 4, 5, 6, 7, or infinity, I guess as they just call it now. So you could even, I don't know, I think right before, that's interesting, June 2007, I remember I was trading equity options. That was when even back then, that was when I remember that people were talking about the credit markets freezing, and certainly well before Lehman. But I think the Fed's balance sheet was about 900 billion pre-Lehman. It's up to 8 trillion now. So that's 8 or 9x in the Fed's balance sheet. So yeah, obviously there was a liquidity issue, but I think that's the same type of thing that, I don't know, I've been looking for in silver, where it's interesting because there's probably some mania price it overshoots to, and then settles at some price in between, all of which, I guess, if you're invested and take some chips off the table at the right time, can be fun to watch and do.
That's exactly right. I mean, uranium, if we lived in a theoretical economic 101 world, uranium should probably be $50 to $60 a pound. No less, no more. But we don't live in a theoretical world. In the real world, this inefficient uranium market, you see how it drove prices well below the price needed to sustain production for years on end. And then it drives prices when it swings to shortfall to prices that far exceed what should be the market clearing price with new production because of those inefficiencies. As an investor, this is the beauty is, we've gone through the oversupply years and we're getting to the tail end of those inventories, and prices start to move, and we start to get, I'm not predicting price goes to $137 a pound, but there are certainly scenarios where it does. And we just know it's not going to stay at 30 bucks a pound, or we're going to have a lot of nuclear power plants with no fuel, and the lights go off in Charlotte, North Carolina, Chicago, and Miami. So it is a very real crunch. I like it because it's a supply squeeze that's not born out of the last 2 days, weeks, or a month. It's something that's been building multi-year. Any commodity that goes through this kind of sustained down cycles is going to have the supply destruction occurring like we've seen, and to have demand so robust. And just we talk about clean green energy. I mean, what about electric vehicles? Elon Musk said if we all go down the path of electric vehicles that many think we will go, he expects electricity demand to have to double to meet that kind of demand. And if we're just filling our electric vehicle, our Tesla, with coal-fired electricity, we can just call it a lignite car. But I think the whole idea is to reduce carbon emissions. And if you have nuclear power plants that run 24/7, charging everybody's cars, vehicles, trucks overnight, and the renewables can make their contribution, during the day when the sun is shining and the wind is blowing. You have a nice balance between the two. And most importantly, you can get to lower carbon. Whether we can eliminate fossil fuels, I wouldn't go there, because I think, the world has 80% reliance on fossil fuels today. But governments are moving down this path. Whether we think it's right policy or wrong policy, doesn't matter. The US is going that way. Europe's going that way. The good news is nuclear energy fits in the narrative. We're part of the solution. And so I think it's imperative that we, in the United States, we're going to be really up on the hill and in this administration and letting them know how we fit as part of the solution. And that's going to be very good for nuclear energy and good for uranium demand.
Yeah, and especially because you touched on the environment we're in today, because that spike, the last one when it hit 130, almost 140 bucks, was 2007, before all this leverage was added on by the Fed. I mean, we live in a world now where GameStop, I don't know the fundamentals. Find it hard to imagine the fundamentals were more out of line than what you just described for the last half hour. And that thing went up 25x in 2 weeks. So, I mean, you could say whatever, and I think you appreciate you said $50 or $60 seems like an equilibrium price, but in a world where Tesla is up 19x since the Fed started swap lines a year and a half ago, again, we don't know what it will go to, but certainly my guess is that some number bigger than what would seem normal with the way these markets work. And I guess, Scott, there's I couldn't go without asking this one, the famous Rick Rule phrase that either the price is going to go up or we're going to stop using electricity. It sounds like that's still intact. Would you agree?
Yeah, absolutely. And, we've seen it in places where, I don't want to come off as anti-renewable, but I do accept the shortfalls of renewables. They're intermittent, they're not very reliable, and they're expensive because they require a backup. But there is a role for them, and society wants them. But look what's happened in South Australia that went so heavily into renewables. California. You can't rely on something that runs 25, 30% of the time for 100% of your energy. So, your backup in most places is going to be fossil fuels today. It's going to be gas and it's going to be coal. If you want that backup to be nuclear, then nuclear has this role to play. the 93 reactors in the United States are 55% of our carbon-free energy. So I think you're going to see a lot of efforts in the Biden administration to sustain the current fleet, extend the permits and life extension permits for those plants, but you're also going to see, which is really a continuation of the Trump administration, investment and deployment and permitting licensing of small modular reactors, whether it's in Tennessee or Georgia or in southern Utah, Idaho and northern Utah. We're seeing these things move forward. So, I think it's great. And the whole ESG movement, I think there's so much money flowing into, environmentally friendly, environmental social governance funds that, how much more capital can they plow into an unknown EV car company that's up 3,000%, has never had made a dollar in its life. Well, those investors and institutions and individuals are now looking at nuclear and going, okay, uranium clearly belongs in the clean energy pot. And so we're beginning to see capital flow in from the ESG world, which really didn't happen 10 years ago. We were carbon free, but we weren't accepted. Now, folks like Peter Thiel, Bill Gates, are saying, no, we absolutely have to have nuclear. And, they're investing with their own nuclear technologies, trying to capitalize on that. So we're in a really good, like I said, it's a collision of mega trends, along with just nuts and bolts supply and demand that are so important in the commodity and resource world. So, companies that can capitalize on that, uranium royalty, is going to be the capital provider for a lot of these new mines around the world that are needed to meet that gap. UEC is going to be one of those mines that meets that gap out of the United States. So the two companies I'm involved in are excellent ways to play this clean energy story. Texas and Wyoming is a pretty straightforward story. You don't have to, get your head around Central Africa or Central Asia. It's a very straightforward story. And the royalty company, listen, if you've seen what's happened to Franco-Nevada, it's a Wheaton Precious, that's a $40 billion industry. Investors love that kind of model, and developers love that sort of source of alternative finance that's in addition to debt and equity. So we have the right model in the right industry at the right time in the commodity cycle for both these companies. So I would encourage folks to look at both of them. URC is traded on the TSXV, UEC on the NYSE. NYSE volume there. It's a very highly liquid stock. It's a very well-known name in the space. Our average daily volumes have increased to about 3 million shares a day, up from our normal 1.5 million shares a day. So this is not a company that trades by appointment. It's a very well-known kind of go-to name in the uranium industry, and certainly a leader in the U.S. with its operations in Wyoming and Texas.
Well, Scott, I can't say how much I appreciate everything you just shared. I mean, I think one of the things get missed these days, it's hard to put things in context. Billions become trillions so easily, but really well done in laying this out clearly. And just perhaps before we wrap up, anything else folks should know about the companies that you didn't cover today? And also, where do they go to get more information, get their questions answered if they want to? What they heard
please,
was
you see our website here, uraniumenergy.com and uraniumroyalty.com. With regards to uranium royalty, check out our news today on the acquisitions of the McArthur River and Cigar Lake royalties. Those are really transformational acquisitions. These mines are of the caliber of like Grasberg or Carlin in gold, or Escondida in copper. And our little company owns royalties in these world-class operations. So we're very proud of this transaction. It was $11.5 million to acquire these interests through Orano's ownership interests in these mines, along with Cameco. So please take a look at that release and dig in. And if you have any questions, please reach out through our IR team at URC or UEC. But happy to provide more background on this transaction and the companies themselves.
Well, Scott, I sure appreciate that. Great seeing you as always, and we'll have to do this again soon. interesting seeing the things that are happening in the markets. Who knows when it will go down, but great overview that you provided. I think folks will appreciate that. And great to catch up with you as always.
Great. Thank you, Chris. Take care.